So the MSc in Finance is a standard 16 months program. It has two streams. One is an investment management stream and the other stream is a risk management stream. So the way the program is set up is that in the first term, students come here and they get some general basic, financial economic, knowledge. Within that term, they also make up their mind towards which stream they want to migrate, the investment management stream or the risk management stream. What we call in financial markets risk, people in the street will call uncertainty. What looks random, what looks uncertain, it doesn't need to look like as uncertain as it is. So we have ways, we have lenses of looking at that to statistical apparatus. We have a way to understand that, and once understanding that, to manage that. Okay, and hence risk is is a way, is a numerical way of looking at uncertainty. Within the realm of financial markets, we often will call that volatility, but there are three words for the same thing: uncertainty, risk, volatility. Risk management as a pool has actually been smaller than investment managers. It is the pool within finance which has been growing the most over the last 8 years, and that's what the crisis of 2008 has given to us. From 2000 to 2008, we all of a sudden thought we understood risk. We were able to conceptualize it and to manage it. What 2008, one of the many things that it has learned us, that risk is always about uncertainty. The moment you think that you totally control it, you go completely wrong. And that's why all of a sudden, big corporations going from GE to Johnson & Johnson, they started to acknowledge that. They started to acknowledge that they don't have those people with those special glasses, those special risk management understanding in place, and hence corporations have been big takers of people understanding risk management, and so have the financial institutions, not in the least because regulation has made them to focus more on risk management. People focusing on risk management are people who are focused on analyzing risk, different pockets of risk, and hence we give people those lenses, we give people those frameworks. Typically you have three types of risk: market risk, credit risk, and operational risk. Market risk is a typical risk you encounter by being invested or by being exposed to all kinds of markets, commodity markets, equity markets, fixed income markets. The credit risk is typically counterparty risk, and that's a pocket that have been only really acknowledged in the last 5 years. Okay, each transaction I do, each trade I do has virtually some person, some institution at the other side. So assessing that risk is what we do in credit risk. And then operational risk is all the risk, everything which is not market risk or credit risk falls under the bucket of operational risk, and hence we give lenses, we give frameworks to our students to assess those. The other stream is about investment management, and hence it's understanding and investing, all kind of investing, going through project investment all the way to investing in commodities and equity and fixed income, what have you. Okay, there's a whole school of thought which helps us to have a process so we can have a way of investing which makes sense. We have a way of looking at diversification which makes sense. If you go in the investment management stream, you will also see part of the risk management. You don't become a risk manager because it's different profile, it's different way of looking at things. As an investment manager, your eyes are on opportunities. As a risk manager, your eyes are on risk. The investment management stream leads to the obvious, becoming a research analyst, becoming somebody who looks at companies, say where the value is, see which business model is superior than other business model. Okay, those kind of functions can happen in the financial institutions. They often happen also in large corporations, and hence large corporation, any corporation going from a pharmaceutical to a steel company needs people who understand about finance, who need to understand about investment management within that corporation, and hence we have people going to both the corporations and in the financial institutions. So geographically, you will find our students, around the globe. We have people, of course, here in Vancouver, but we have a lot of them in Toronto. We have in New York. A lot of them go to the big new powers, being India and China. Okay, and a whole different spectrum of jobs, going, from research analysts to analyzing big projects, all the way to people who trade in market or who analyze the risk of the people trading in those markets. So it's a very big spectrum. I think the reason why we've been so successful at this is because those two streams, run very close to each other. The students come off the same pool, the students know each other, they keep on talking to each other, okay, and each understand, the other spectrum far much better than a lot of the other programs which are in existence today.